Welcome to the Disruptance Podcast. Here are your hosts, Eric Forney and Michael Bounds.
So every week, Mike, on the show, we aim to disrupt the way entrepreneurs and real estate agents think about their business. And this week, what I want to do is disrupt the way you think about money. Have you ever thought about money and what money is?
I do.
Okay, everyone has probably thought about money. Have you actually thought deeply about the concept of money?
I haven't. Because, and this is the thing. I love it because when we talk, the times that I have, it's with you. You kind of stretched me on that.
Yeah, it's interesting, and I feel like this is really timely on the heels of the Reddit, GameStop, Robinhood, Wall Street, knockdown, drag out event we've seen the last couple weeks. So it really got my wheels turning about the idea of money and how money is supposed to create freedom for people, and that money might just actually be a construct of our imagination. So, in a little of this is going to be maybe a little heavy from a technical perspective or from an annoyance classroom standpoint. But when we think about money is nothing more than the medium of exchange,
right? And
accounting. So, accounting being I gave you X number of currency units and you will repay it in X plus Y, right? So it's just merely a medium of exchange. So in prison, for instance, money is often cigarettes or wine.
Right.
And of course, in the U.S., money is U.S. dollar.
Right.
However, at a point in time, it was gold, and it's been tulips. We've seen salt. We've seen all sorts of farm animals.
Right.
Money has been a number of different means of exchange. And so the properties of money are that it must be divisible.
Okay.
So you have to have the ability to exchange it in multiple increments. So think coins and bills, right? So a dollar bill can be divided. That it has to be durable. So it has to be something that has the ability to hold value over time. So cigarettes are not nearly as good of a currency system as a bar of gold.
Right.
A tulip was not nearly as good of a storehold of durable wealth as a coin might be. And so money also has to be portable. So you have to be able to take it with you and trade it. It has to be movable. So a house would not be a good means of money. It needs to be recognizable. So that has to be trust. Like you have to exchange something on the basis of trust, and you have to believe that it's true. So how do we do that in the U.S.? We do it by printing a identifiable dollar, and then there are all these like counterfeiting measures and mechanisms in place so that there's an increased level of trust. Previously, we saw coins that are stamped. And then if the thought was, if this coin is good enough for the king, it is good enough for the commoner. And that was the authenticity of the portion of money. Money has to be scarce. So there has to be the ability to have a constrained supply so that you can protect your value and consequently protect the trust. So tulips, albeit there was a tulip bubble of when tulips were deemed to be a means of money, tulips aren't scarce because you could just plant more tulips, or there are more tulips this year might grow than next year. Gold has traditionally been the most scarce of our monetary systems because you have to mine new gold every year, and that costs money and is really, unless you go lasso an asteroid, like Elon Musk has talked about, you're not going to inject a huge supply of gold into the system.
Right.
Now we have dollar bills, which are less than scarce, especially less scarce than they once were. And then the last thing I think is security. So you have to have the ability to protect your exchange mechanism. So you protect it from fraud or from theft. So a bar of gold gives you more security than a tulip, than salt. A dollar gives you mechanism through a bank account that has insurance and so on. So money, medium of exchange, but it has principles attached to it that make it better or worse as a trusted exchange. So what does all that mean? Well, my thought around that is when we think about wealth and we think about freedom, in 2021, we live in a world where when was the last time you had an actual dollar bill in your pocket? And when your means of exchange was actually through coins and dollars.
Yeah, it's crazy how quick we've gone to, like, what do you call it, a cashless society.
Yeah. And so we live in this digital currency system today. And the only thing we really exchange is trust. Yeah. Right. And so when you exchange money to the mortgage company and we exchange money to Kate and Tyler for this podcast, the only thing we're really doing is exchanging trust that they can take it to their bank and it have the same value that they received on the time in which we sent it to them. Right. And so the monetary system is really, in my opinion, a trust system with the least amount of volatility possible. Okay. Well, here's the problem. Yeah. This week and really this is a culminating event over the last couple of decades. We've seen a large erosion of trust in the financial system in America, and that was embodied by this amazing Robin Hood. Yeah. This amazing Robin Hood-like actions of the Reddit traders attempting to short squeeze the hedge funds in the past week. And it worked really well. And it also brought to light the fact that there's a significant gap in trust in our current monetary system. Right? And that lack of trust is that on the day in which hedge funds were going to essentially lose billions and billions of dollars, a number of the trading platforms decided they would cease all acquisitions of GameStop stocks.
Limiting, like, you just totally stopped it. That's crazy.
Right. Which then meant everyone who was earning the run-up, the income, the profit from the run-up, either lost their gains or lost their ability to transact out of their position, or potentially got dissolved out of their positions, and weren't able to actually either cash in or accomplish their desired outcome.
Right. Which is what they've been doing for the last 50 years.
Correct. So the hedge funds have been playing this game against the greater population, and all of a sudden the tables got turned. And part of why the table gets turned is because we live now in this world where information transacts at a record speed, in which everything, for the most part, is available to everyone.
Absolutely. Thank you, social media.
That's right. Yeah. Truly, the ability to find information on the internet now and learn about something has been the great equalizer of knowledge and wealth. And that doesn't sit well for those people who have wealth.
The status quo.
That's right, because everyone's trying to maintain a standard of living, right, or move their standard of living up the social construct. And so as soon as Melvin Capital is poised to lose $3+ billion to some dorks on Reddit, that's right, yeah, it changes the social construct. Yeah. And so what we've seen is the system itself change overnight, in order to try to prevent that social construct change, or to change the way that money is actually made and wealth and influence is created seemingly overnight.
It sounds like you said they changed the rules.
They changed the rules. Absolutely. Absolutely.
So what happened was everybody else kind of figured out what they've been doing. Mm-hmm. And then they were like, you can't do that. I'm changing the rules.
Yeah. And the reality of it is, Mike, is that movement was amazing. Like, that GameStop Reddit movement is like world-class grassroots effort, probably unlike anything we've seen. However, I believe it is a vote for what the future looks like. Yeah. Is that grows more and more and more and more common. We've seen in the last decade, we've seen the Wall Street movement, we've seen the Me Too movement, we've seen Black Lives Matter movement. We're starting to see these social constructs and the unity of people accelerate at a rate that wasn't seen in the decade plus prior.
And on the other side, you're seeing negative people come metastasize, and so anyway.
Yes, because what happens is we all cling to our social hierarchy, right? Our standard of living. And the challenge becomes is that the standard of living has gotten arguably worse as the decade has gone on, because the wealth divide has continued to grow. And so what actually happens is everyone in the middle feels like they've been left behind and left out. And so whether their view aligns with Me Too, Black Lives Matter, or
whatever,
right, it doesn't matter. That's right. They all feel left behind.
Right.
And numerically they have been. Right, as the top 1% continues to grow, it leaves the 99 continuing to fall further and further behind. In fact, they say that 50% of Robinhood accounts owned GameStop stock last week alone.
Wow.
Which means 50% of the retail investors were betting against the hedge funds last week, and the hedge funds decided to change the rule.
Yeah. Overnight.
And so what does that have to do with being an entrepreneur and a real estate agent? Well, I don't know. It's a great question. However, my thinking is that we're always talking about building wealth, increasing profitability, and changing the way that people think. And so when I think about what happens with this financial sector that has really been corrupted by what is just, there's no product produced by a hedge fund. It is just truly wealthy people getting wealthier. That's it. It's just managing wealthy families' funds in order to continue to grow the wealth. No product is created, however. And so when we think about that, the beauty of the industry that we're in is that we actually have the ability to invest our income or our earnings into a relatively low risk, non-manipulatable asset
tangible
of real estate. That's right. Yeah. Because even when you buy stock on Robinhood, you don't actually get the stock.
Yeah.
You merely exchange trust that app or that broker was going to return you the money that you claimed on the app that you've earned.
Just talk to your clients that you sold them a house 3 to 5 years ago.
Yeah.
5-10 years ago. So they're really happy that they made that investment in real estate.
Yeah.
I mean, the way houses are selling right now. It's crazy.
Absolutely. And so that kind of got me down this rabbit hole of the idea of like, what is wealth? Like, how do you actually build wealth? Well, one of them is just that asset appreciation.
Yeah.
Right. Like where you have an asset. In this case, we're talking about a house that goes up in value, or maybe you have a used car, because we've seen Jay Leno's wealth go up by owning assets of used vehicles because they're in scarce supply. And so the value goes up. You can also build wealth by having a profitable income growth. So if every year you get a raise and that becomes exponential, or you own a business and you grow your business's profitability, that profitable income growth leads to wealth creation. That you can acquire businesses, and by becoming an entrepreneur by acquisition, you grow your wealth, and then by compound interest.
Yeah.
And so when we think about wealth building, the beauty of the industry of real estate is that it really factors into asset appreciation, profitable income growth, and acquisition of business, as well as compound interest. There really are multiple vehicles of wealth building inside of owning real estate.
You're absolutely right. We focus on compounding interest. I'm talking about even before I got into real estate. But I had to change my mindset from a consumer driven mindset to where, when I say consumer, I can afford that. I can make that payment versus I want to receive a payment.
Yeah. Yeah. That's a big difference.
And when you start thinking like, okay, multiple ways to receive payments and not to make payments, it shifts it changes the game.
Yeah, because what you're doing is you're changing really your basis of income and your basis of net worth by doing that, and that you're able to balance out your expenses with income by having that mindset. And so when I think about risk and what we saw last week with GameStop and with Robinhood, the risk for real estate right now is incredibly low. And part of why it's low is because the manipulation happened 15 years ago to our industry.
Yeah.
And that obviously cost people a significant amount of their livelihood, of their wealth. And fortunately, what we've seen is government regulation come into the industry to actually solidify more of the risk.
And it's actually
involved.
working.
That's
You're
right.
not seeing foreclosures. You're not seeing any of those things. We're in a pretty bad situation, and foreclosures have stayed constant even over 2020.
Yeah, that's right. Surprisingly, with 15% unemployment at its peak, we still are expected to see roughly the exact same number of foreclosures in 2021 that we saw over the last 5-year aggregate, which is unbelievable, and it shows the rate of appreciation we've seen in the real estate market. Yeah. Now, there are a couple things that concern me about real estate wealth right now, Mike, and that is
what's that?
31% of the market right now is first-time home buyers.
Okay.
Traditionally, we like to see a 40% average for first-time home buyers. So we've seen almost a 25% decline in first-time home buyers. Well,
I have an idea, but why do you think that is?
Well, we're starting to see, we have seen for the last decade hedge funds consume 11+% of the market inventory. Okay. So last year, we set a record for the total number of investors acquiring property nationally. So BlackRock, for instance, has 80,000 plus homes with Invitation Homes. We've seen in our market, American Homes for Rent, First Key Homes, Progress Residential, Main Street, all these large entity companies acquiring houses. That puts downward pressure on the first-time home buyer. It does. As far as supply is concerned, and then drives up the price, which makes it more prohibitive for the first-time home buyer. Yeah. Couple that with student loan debt, and now we've got fewer and fewer first-time home buyers despite zero effective interest rates.
And you have no builders anymore serving that market. So, I mean, the last really good one was CP Morgan. And so so
the
like,
Arbor, the
CP Morgan or the Arbor, and Arbor's not really serving that market anymore. So not only do you have the pressures of these people coming in and buying first-time homebuyer communities, you don't have a replenishment of said product. Yeah. So, I mean, it just kind of puts it in a pinch.
So no one serves the market or services that market. And then currently we have where institutional investors are really cannibalizing a large portion of the supply, which is driving up prices as the supply continues to go down. Right. In fact, right now, like the last week I looked at numbers, 380,000 properties for sale in the United States. 380,000 homes for sale there's 330 million people that live in the US and 380,000 homes for sale. Yeah. And so you're seeing the compounding effect of the last decade of not having enough housing starts, institutional investing, debt for first-time home buyers, and a chain reaction of because the first-time home buyer becomes typically a first-time home seller. Yeah. It's a game of musical chairs.
Yeah, absolutely.
And when you take one person out of the game of musical chairs, or when you start taking chairs out, you change the dynamic of the game itself. Yeah. And everybody starts off as a first-time home buyer. That's right.
If you never buy a house,
and somebody's a first-time home seller. And so we need that dynamic to exchange in order to create this market. And so when you see institutional investors, let's say an invitational home, when you're an 80,000th first-time buyer, then you change the market of musical chairs in real estate. And so we're seeing this effect. So what does it mean for creating wealth and freedom? Well, in my opinion, it means that if you can find a home that comps out as far as numbers are concerned, then you're likely in a good position.
You better buy it.
That's right. That's right. It also means that we're going to start seeing in the real estate industry a possible rebalancing of income from a real estate agent perspective.
Right.
Because as fewer and fewer houses go up for sale, that means fewer closings.
Right.
And as a result, that means the number of agents who are able to sustain a decent living begins to go down because there's less commission dollars to be exchanged in the overall market. I know, Mike, in one of our markets where our office is, there are 3,500 houses in this market, and there are 5 homes for sale.
Yeah.
5 homes, 3,500 homes, 5 homes for sale. As a real estate agent, it's incredibly challenging to figure out how to earn an income on that mathematical equation.
Yeah. You know what? The market is so good, it's bad. That's what's going on. Like, it's so good for sellers, it's bad. Like, if you're a buyer's agent.
And at this point in time, I don't see a way out. Mm-hmm. I mean, I'm sure that sooner or later something breaks. However, there has to be a tipping point of rebalancing between institutional investing and home ownership and rent rate.
Yeah.
So that the only thing that may tip this. So if you're thinking about getting into real estate investing, the one thing that I think I'm risk averse with real estate investing, and that's because I don't know, I'm just risk averse I don't want to make money and then lose it.
Yeah.
So I'm risk averse and low on speculation. So my belief is that if you're running numbers on a rental property, don't run them on today's rate. Back that number down and run it as like a worst case scenario to see if the numbers actually comp out. Because we're seeing the number of renters who earn 6 figures go up at a historic rate.
Okay.
And what that tells me is that despite earning 6 figures of income as a household, there are some people who still are unable to own a home. In fact, in Denver, the median income, in order to buy the first-time home buyer median property, you have to make 2x the city's median household income. So the house costs 2 times the average income.
What you make.
Which means your only option
is
without going into debt is potentially renting, right? Yeah. And so that balance has to shift eventually, where rent rates actually try to climb too much to make it prohibitive to find renters who can afford to rent the property.
So what happens? Like real estate is scarce, home prices are high, rent goes up, rent prices are high. Like, what happens?
Well, this is the reason why I like real estate from the perspective of investing comparative to like a stock.
Got it.
And well, one, I mean, there's 4 or 5 different ways to monetize it, but one reason why is that when we think about stocks or most investments, we see them from the perspective of growing our like wealth as an asset class.
Okay.
And I'm going to make the argument that says that real estate is not actually an asset, but it's also not a commodity.
Okay.
And I'm not exactly sure what category to put it in. I actually think it's a human right.
Okay.
Because shelter is a human need.
Sure.
And so when we factor in the need for housing and we see what the government is doing from an eviction moratorium perspective,
right,
we see that there is a unique construct of a social element blending with an asset class.
Got it.
And so one benefit is that real estate is highly regulated to try to keep people in their homes and to try to keep renters in the home, and so that the government doesn't have to be a housing provider.
Right.
And so I think that our system is structured for homeowners,
Right.
and that the government tries to tilt the balance as much as possible to enable home ownership. And if not, at least they'll err on the side of housing as a human need.
Right.
And so as a real estate investor, there is a degree of security in knowing that you're providing someone a human need and monetizing it. Whereas if you're buying GameStop stock, there is no human need to that. You're just playing the casino.
So the way we get out of this, it sounds like to me, is government intervention.
Well, that are just market dynamics, and eventually in general that says, okay, we're trying to squeeze up rent rates so high that it's prohibitive, that the market has to pull rent rates back.
Got it.
Or that the prices go up too high of purchase price, and that hits a threshold where buyers are unwilling to purchase, and that starts to pull pricing back. Because there's really not much more incentive on the interest rates that mortgage companies or that the mortgage industry can do to try to make housing more affordable.
Okay.
Housing is becoming less affordable by the day.
By the day.
And so as a result of that, that means that at a certain point we hit a threshold where affordability becomes the limiter.
Right.
And then you see, which is why, interestingly, I've noticed a change in behavior from the institutional buyers in the last 30 days to where used to, if you had a listing with a hedge fund where one of the hedge funds was making an offer, they'd come in at below list
cash,
price, but it was cash and it was quick.
I got one to go up.
You got 20. Were you telling me about one that was like 20, 30?
Like I got one to go or it went 8,000 over.
Okay. Yeah. And so another agent told me last week they got 30K over out of one of the hedge funds too, which is concerning to me. Because
actually another hedge fund called me because they saw that it was pending and they asked, they were upset because they made similar offers and I told them they gave me over asking.
Yeah.
Yeah.
Yeah, that's a new dynamic shift for us, is seeing institutional buyers buying above list price.
Wow.
Which tells me that they've rebalanced their calculation on what they're willing to pay, with the thought of driving appreciation has to factor into that equation now, or tax benefits.
Yeah.
The thing that I like still about investing in real estate, again, though, is that when we think about how do you build a portfolio to insulate yourself to create freedom financially? And I think about real estate offers you a human need, which is good, from a risk management standpoint, and wealthy people and influencers in political structures own real estate.
Yeah.
Very rarely do people make policies that inflict damage onto themselves and onto their social network.
Yeah.
And so the likelihood of having a policy that is negative from a taxable implication perspective on real estate is low.
Yeah. It's the thing that I kind of share this with my clients in the middle, like when I meet with them, I tell them, okay, like imagine you are in a DeLorean and we go back into time. Okay.
Okay.
And a lot of them, I got to explain what
a DeLorean is, right? Yeah.
It's kind of...
Tyler, do you know what a DeLorean is?
Y'all know what a DeLorean is?
Okay.
All right. So I just explained to them, if you go back and you buy Apple stock, and Apple stock in 1989, I'm just throwing something out there, it's $10 a share. Okay. It's $10 a share for Apple stock. And you go to the guy and you say, I want to buy the Apple stock. And the guy says, I'll sell it to you for $11 a share. In 1989, you would be upset. You'd be upset you paid $11 for that $10 Apple stock. Yeah. But in 2021, I bet you would think you were a genius. That's what buying a house is.
That's right. Yeah. Over a 30-year timeline, there has not been a time in which you didn't re-earn your initial investment, at least from a national perspective. Are there markets that are outliers? Of course.
Yeah.
However, from a national perspective, over a 30-year aggregate, you earn back your initial acquisition price and 3x.
Right.
So over a 30-year time frame, it's about 3x.
So what makes it not an asset, or buying real estate not an asset, is you're right, from a capital gains perspective.
Yeah,
it goes up. But the thing that the part that makes it not an asset is the asset actually, is bringing money in. And while you're in your home, you're not actually earning money at the time. So what would that be? That would be the
well, I looked at it too as the difference between, and like I guess the way I kind of backed into my analysis of real estate is thinking that like assets are typically storeholds of value, and a home is a storehold of value. However, it's more.
Okay.
And that's because
the social aspect.
That's right. The social construct of a home makes it different than other asset classes.
So you're saying that it's an asset plus more.
That's right. You get the benefit of low risk investing in real estate because of the social element of a human need. Okay. And that is that because our government and our society, thankfully, is evolved enough to believe that social needs are important.
Right.
The likelihood of someone coming in and saying, "Hey, Mike, thanks for buying this home, but we're going to have to take that from you.
Yeah.
We've decided to change all the rules."
Yeah.
They're able to do that on GameStop, but they're not going to do that most likely on your home because you become then a burden on the government.
So you're saying stop investing and gambling on GameStop and come buy a house off of us.
And unless you're making bank. The reality though is that if you can, the real multiplication is if you can game the system the way that it has been done by Wall Street for the last couple decades, then you invest your income in real estate, which is what the hedge funds are doing.
Got it.
Right. So we're seeing large family wealth networks, hedge funds, buying real estate as an additional storehold of value and some stream of income. And so when we think about like risk and, kind of 50 years from now, let's say, if you were going to look out and retire, would you feel more comfortable knowing that you had 10 rental properties or 10 shares in Apple, GameStop, whatever that is?
Yeah.
You would likely feel a lot more comfortable owning 10 parcels of land or 10 pieces of real estate in the right markets.
Right.
Now, if you own property in California right now, might be a bad time.
Right.
Because of the migration pattern, right? If you own in Austin, Texas, you're really liking this migration pattern.
Right.
So a lot of it depends on, there is some outside political and influence of the entire greater macro market. However, it, in my opinion, is one of the lower risk wealth building vehicles right now, especially.
Okay.
What would you say to somebody that made 20 to 30,000 from GameStop? What
I would give him a huge high five.
What should my friend do?
Did you make 20 to 30,000 from GameStop?
My
you
friend
wouldn't be
did.
here right now.
Yeah, I want to be here. I'd be blowing it all on like AMC.
You'd have like bling. You'd have like a grill.
I'd spend it all.
He'd have personal pan pizzas and 20 G's and chicken nuggets already. If so,
that's funny.
I bought a McDonald's.
What would I do with it? I would invest it in something that is that is insulated from like long-term taxable gains personally. So that's one main benefit of real estate is all of the tax benefits that come with it.
Right.
So can you buy a house that's like obviously going to need probably some work on it for 20 to 30,000 if you had that cash?
In our market, you can.
Can you?
Yeah, I mean, you could buy. You could buy a house levered and do that. So like, you could buy $100,000, $80,000, $90,000 property with a mortgage. Use the $20,000 as your down payment, $30,000 as your down payment, and then allow the low interest rates to be a fictitious rate of infinite return almost, because I just called to refi some properties last week and it was 3.75, I think, even as an investment property.
Which rates, I think it was like 2.7 or 2.
So So at 3.75, it just thinks I've now on my property, I've got a write off on the interest. So let's call it 30%. So back out 30% of the interest as an expense deduction. I'm going to deduct 1/27th of the property value every year due to depreciation. And then I'm going to deduct any of my expenses affiliated with the property itself. And then any acquisition costs of that are considered to be business expenses. And if I spend enough time investing in real estate, I get to change my tax designation to become a designated real estate professional, which allows me to reduce the capital gains tax if I do actually make more money, and allows me to write off more expenses than I would if I own one or two properties in a W-2 job. So there are some I always think there's usually about 5 ways to make money in real estate. Debt pay down being another. So if I get a mortgage, someone else is paying the mortgage. And then I'm ideally getting appreciation. So I've got income from I've got wealth growth through appreciation as well.
Right.
And so, yes, somebody who actually has figured out how to, place lucrative bets in the market has absolutely the ability to move into a more risk averse market like real estate. The one downside, I think, is that it's investing in the stock market, unless you're willing to put it and hold for 10, 20 years and have a manager, is investing in the market last week was highly active.
It's scary.
Yeah. And it took work. I'm not going to pretend that I didn't get involved in active portfolio management last week.
It's like a job.
Yeah. I mean, I didn't leave the office one night till almost midnight because I was watching the ticker and trying to cash out. What's that?
You just took up smoking and everything. Just for Wall Street.
Yeah,
that's right.
I was suits out.
I was watching the ticker on Dogecoin, trying to see when I needed to get out of that investment. And as a result, it was an active.
Yeah. The problem is people, and right now it's exposed. It's literally gambling.
Yeah.
It's literally like people from Vegas have figured out Wall Street and stocks.
That's right.
They're treating it like when I grew up, it was buy a stock and then you let it sit and it was a long-term thing. And folks have literally flipped that on its head. And so this is what you got.
Yeah. The downside to real estate can be that it can at times be an active management as well. Right. So owning a home is certainly not without work, time, and investment. Yeah. Obviously you can leverage that out to property management. Then it just becomes you're trading your active real estate work
leverage
for money.
Money.
For someone else to take that burden on. Right. So I used to actively manage my own properties and do not anymore. Yeah. Because I'm a terrible property manager for my own.
Yeah, it'd be horrible.
That would suck. What's the so there's new houses being built up where I'm from on the northwest side of Indy, and the neighborhoods, they sell out really quickly, and then you can sell those newly built houses for more money. So is there any benefits in just building a house and sitting on it until the neighborhood's built out?
Yes.
And then selling? Because I feel like there's tens of thousands to be made.
There's actually a model to this is what I'm not in the position where I can do this. As soon as a new neighborhood opens up, buy 1 or 2 of those houses and sit on it and rent it out.
Yeah, Airbnb it, rent it out long term.
Airbnb, whatever, hold it.
Because they're building them for mid 200s right now.
Yeah.
I'm like, you can't get that
every time and what happens? They come in low. Yep. You can literally go in there and build them and sit on them.
Because that's your background, right, Mike, is new construction. And so
see it.
As each phase is released, the market value goes up, right? I mean, it's basically baked in price increases.
They take price increases the whole time, but if every time a neighborhood opens up, that is the lowest price of that neighborhood. Ever.
Unless the entire macro market changes, right?
Unless the market. Now, I have been in real estate where I worked in a new home and they took price decreases. I've been in the game that long. So that was probably almost 15 years ago, 13 years ago. I remember they were saying, hey, we're taking a price decrease. But ever since then, I'm telling you, like, and I see it. I'm just not in a position of y'all gonna take my idea, but like literally, that is, you could do that. You could literally go in there and build the smallest ranch.
That was Florida.
Like
that was truly what was happening in Florida. Was people were flipping them before they were even completed.
Done. I've got one right now that's
which would be an really interesting model to do here.
Yeah, I know. I'm like,
could you find a buyer for? Could you put your own new construction deal in contract and then flip the contract to a real estate agent who has a buyer?
Yeah,
who needs a property, because there just is nothing to choose from.
There's nothing.
I mean, we looked at slides last week. There are 40 homes on the market in the market that Mike and I are in, where our Keller Williams office is. 40 listings. 40. 40. We have more real estate agents in our office than there are homes for sale.
Producing.
Yeah.
All right.
So that you could potentially look at that. I mean, there are a lot of dynamics at play though too. I mean, we're seeing off-market inventory transact at rates we've never seen before. You know, I had some people reach out about multifamily yesterday, and so there was like 11 houses or 11 duplexes or quadplexes to look at on the MLS in the areas they wanted to be in, and in the greater board, there were 54 duplexes or quadplexes and 2,700 single family. So 54 compared to 2,700 single family, which tells me there also now is a run up on driving for duplexes and multifamily.
Yeah, everything's getting snatched up.
Because when you look at the asset appreciation, that's been a really, really low risk
absolutely
way to grow wealth. Now there's all sorts of other things at play, right? Like the printing of money, the unlimited supply of monetary stimulus this year. However, at least asset right? You mean you haven't gotten that promised 1,400 or whatever?
I haven't gotten it yet.
So that's where real estate becomes a much different vehicle for actual low risk, secure wealth building compared to where the rules change at any given time, like we saw last week in the market itself.
Right.
So packaging all that together, now we know what is money, right? Money being an exchange of trust and something that's portable, divisible, something that can be secured and is a medium of account. And we haven't even bothered to talk about digital money yet.
Yeah.
Well, we'll go on a long rabbit hole, I'm sure, sometime of digital currency, because that becomes an interesting asset class when you think about wealth building. Is as time continues to go on, digital currencies will start to make more and more sense to people as we become more and more cashless.
Yeah.
But the hangover of being a cash-based society is to a large degree causing people to not understand digital currency.
Right.
And so as we seem to have no problem swiping a credit card, which is digital currency.
Right. Yeah. We're getting it. We're about to get it.
So it's an interesting asset class that we can discuss at a later time. But wealth building now to me is the time to do it, and do it at a low risk buy-in point like real estate.
It's out there, y'all. You just got to go get it.
And real estate to the moon.
Yep.